Let us talk about cash flow perspectives. See, cash flow can be prepared from two stakeholders' point of view. That is, one, it can be prepared from equity shareholders' point of view, and the other one, it can be prepared from lenders' point of view. So when you prepare it from equity shareholders' point of view, you basically arrive at cash flow like this, that is PAT. Then we'll add back depreciation, and this would tell us what is the cash flows after tax. Okay, that is, if you take PAT and if you add back depreciation, that would tell us what is the cash flows after tax. But when you go to lender's point of view, then you have to take PAT, then you should add back depreciation. You have to take PAT, you should add back depreciation. Okay, then you should add interest also. You should add interest, and when you add interest, you have to multiply that with 1 minus t, where t represents your tax rate. So if you do all this, you get your cash flows after tax. You get your cash flows after tax but before interest. I'll call it as cash flows after tax before interest. Okay, now tell me why we are doing this exercise. See, please understand, here when we calculate the cash flows after tax from equity shareholders point of view, we are trying to understand whether these cash flows are sufficient to pay dividends or returns expected by equity shareholders. Whereas when we calculate cash flows from the lender's point of view, we are interested in understanding. See, the cash flows from the lender's point of view is also called as project cash flows. So when we calculate the cash flows from the lender's point of view, we are interested in understanding whether these cash flows are sufficient enough to pay the interest which are expected by the lenders and dividends or say returns expected by equity shareholders. Okay, so understand, when we calculate it from the lender's point of view, we are going to take care of the overall requirement, that is interest and dividends. But when you calculate it from equity shareholder point of view, you are just going to focus only the expectations of equity shareholders. Okay, now to understand this, let me give you a simple example. Let's say our sales, I'm going to give an arbitrary number, sales is 100, and my operating expenses, let's say before depreciation, my operating expenses before depreciation, or put it rightly, excluding depreciation. Okay, let's say this is some 40. So from sales, if I subtract this operating expenses, let's say I'm going to get earnings before depreciation, interest and taxes. So 100 minus 40 is 60. Now let me subtract depreciation. Let's say my depreciation is 15. Okay, so I should get earnings before interest and tax, and that should be 60 minus 15, which is 45. And from this, let me subtract interest from depreciation. From EBIT, let me subtract interest. Let's say my interest is 12. Okay, so here I get EBT, and that's 45 minus 12, that is 33. Then let's deduct tax. Let's say tax at 30%. So 33 into 0.3, it works out to 9.9. Okay, then I get EAT. EAT is 33 minus 9.9, so my earnings after tax is 23.1. So now let's try to find out the cash flows from equity shareholders point of view. So if I am doing it from equity shareholders point of view, it is simple. It is basically my earnings after tax added by depreciation. Okay, so it is earnings after tax 23.1, then I should add depreciation. I should add depreciation. How much is that? It is 15. So my cash flows is 23.1 plus 15, it is 38.1. So this is from equity shareholders point of view. Now I'll put it here, cash flows from lender's point of view. Cash flows from lender's point of view. So I'll start with earnings after tax, and it's going to be, I'll put it here, it's going to be 23.1. okay, then let me add depreciation. Let me add depreciation, and the value of depreciation is 15. okay, so I'll put them here, it is 15. Then I should add back interest. I should add back interest. Let's say my interest is 12. My interest is 12. okay, so now if I add all the three, that is 23.1 plus 15 plus 12, I'm getting my cash flows as 50.1. So this is my cash flows calculated from lender's point of view. But this cash flow is not satisfactory for me for a reason that I'm adding back entire interest. Look at here, my interest is 12. I have deducted, and since I'm calculating it from the lender's point of view, I'm adding it back, but I'm not convinced, because when I try to calculate the cash flows from lender's point of view, I want to reach the EBIT as if there is no interest in that company. Okay, so how do I understand that? Let me simulate the scenario as if that there is no interest. That's my sales going to be 100, my operating expenses are 40, so my EBIT will be same 60, depreciation 15, so my EBIT here, this is EBDIT and this is EBIT 45, and I don't want interest. Okay, so I'm going to make it as 0, and my EBT is going to be 45. My tax at 30% on 45 is going to be 13.5, and earnings after tax is going to be 31.5. So in this scenario, if I add back, what will happen? Let me introduce some rows to explain. Okay, in this scenario, if I add back the depreciation, what will be my cash flows? So what is my depreciation? My depreciation is 15. So if I add back these two, I'll get my cash flow as 46.5. So I have to find out the cash flow as if I don't have any interest in my structure, because it is from that cash flow I have to pay interest, but this cash flow is not the right one, because look at here, this cash flow says it is 50.1, whereas this scenario says your cash flow before payment of interest should be 46.5. Then what is wrong here? Why this cash flow is higher and why this cash flow is lower? See, this cash flow is influenced by tax savings on interest. This cash flow 50.1 is influenced by tax savings on interest. How? Look at here. What is the EBT 33 when you had interest? What is the EBT when you don't have interest? It is 45. What is the tax when you had interest? 9.9. What is the tax when you don't have interest? It is 13.5. It means the presence of tax has helped you to, the presence of interest has helped you to save taxes. If you don't have interest, you will end up paying tax of 13.5, whereas you have paid tax of only 9.9. So you have saved tax of how much? You have saved tax of 3.6, right? You have saved tax of 3.6, or I'll put it in 2 decimals, so you will get the perfect number. Yeah, you have saved a tax of 3.6. And why did this happen? This happened because of presence of interest. So when you have subtracted interest, it has helped you to save tax by 3.6. So when you add back interest, you have to do the opposite, right? When you have subtracted interest 12 and when you are adding back 12, you should also give the opposite effect for the taxes. That is, you have reduced your taxes by 3.6. Now you increase the tax by 3.6. Okay. So what originally happened here is you have reduced your expense by 3.6. Okay. So now you should do the opposite. How it should be done? Or put it otherwise, your income, that is your tax, has helped you to increase your profit by 3.6. So now do the opposite. So it can be solved in two ways. One, what I can do is I can take interest, I can multiply it with 1 minus t. I can multiply it with 1 minus t. In that case, it will be 12, that is my interest, multiplied by 1 minus t, which is 0.3. Okay, in that case I'll get 8.4. and look at here, my cash flows from lender's point of view is 46.5. that is a stage as if there is no interest in the entire process. So look at here, you get 46.5, 46.5. So this is one way for approaching. There is another way, I'll show it. Let me drag this here. Yeah. So what I'm going to do is I'll simply add the interest. I'll not go for any calculation. I'll simply add the interest. But one thing which I have to realize is interest was an expense. It was subtracted, so it is added back. So similarly, tax was there. Okay, this tax should have been 13.5, whereas it is 9.9 now. So it means there is a presence of tax saving. Now since you are removing the interest, then remove the presence of tax saving arising from interest. So since it is already included, I am removing now. So less tax savings on interest. So that is one way of approaching this. So what is the tax savings on interest? That is 12 into 0.3. Okay, so that gives 3.6. and if I sum them now, if I sum them, what I'm going to get is 46.5. So this is the difference between calculating the cash flows from equity shareholders point of view. When you calculate it from equity shareholders point of view, it is only 38.1, but when you do it from lenders point of view, it is 46.5, and many will not get this rightly. They'll simply add interest, no interest, after adjusting for this tax savings on interest.
Thanks for watching this video, and I hope you liked this lecture. If you wish to learn more on the areas related to this topic, check our comprehensive course. I have shared the details and link in the description below. Click sign up and enroll. I'll see you inside the course.